Evercore is reshuffling its top internet stock picks. Amazon and Doordash replacing Alphabet and Shopify following second quarter results. Joining us now with more in his report, Mark Mahaney, Evercore ISI, head of internet research. And you, this is in the wake of the second quarter. I guess the first thing we can say is the internet is more important than the fax machine. Paul Krugman, what year was that? Was that I don't remember exactly what year that was.
I don't remember either, but that sounds like a factually true statement.
So after this earnings report, I think we can just put that to bed once and for all. It has been a pretty big trend, the internet, in all of our lives. You're making some moves. Is there some overall change in your view on the whole sector after the second quarter results?
Yeah, let me try this. I had two takeaways. One is, do we get more soft or hard landing data points? And I looked at all these companies, whether they were travel names, retail, advertising, delivery, mobility. There's a whole swath of names in there. I think they more guided you towards a soft landing than a hard landing. There were some issues in there, some of the travel names in particular.
Yeah.
But most of the names had pretty consistent fundamentals, and some of them had fundamentals that actually materially improved, even those consumer names like a Netflix and a Spotify. So I sort of thought the takeaway was more soft landing than hard landing. The second one is anybody showing a return on all of this AI spending? Is there an ROAI? And I think if you look hard enough, you can find that evidence. If you look at Meta, if you look at Amazon, if you look at Google, the three biggest spenders that are spending, I don't know, $150 billion in CapEx capital expenditures every year on AI, I think you're starting to see these returns. AWS growth acceleration, Meta being able to improve its products and its user experience and seeing rising usage and rising return on ad spend. So I think you're starting to see the evidence come in that they're getting a little bit of a bang for all of those bucks they're spending on AI.
You said it's a little bit of a bang, like you're turning, dollars into digital nickels and dimes type of?
I don't think it's that bad. I mean, frankly, if you look at what's happened with Meta, their ability to, they went back to almost 30% revenue growth. I mean, they're growing dollar-wise faster than anybody else, and it's because they used AI to rebuild their ad tech stack, because they used AI to rebuild their user interface and get us more engaged. So it actually worked for them, and if it works for them, my guess is that'll work for a few of the other companies.
Across the board, travel seemed weak.
Yes, it did.
Why?
I think it's the most well, for internet companies, it's the most discretionary part of spend, and it's the category that's most penetrated online. Internet's been around for a long time. One of the earliest manifestations of it, the use of the internet, was booking travel online. So it's not like there's that much secular growth. Whereas DoorDash and Uber, I think, have got a fair amount of secular growth ahead of them. So they're less macro impacted.
DoorDash is now one of your
top three picks.
Okay, your top three: Amazon, DoorDash, and
Uber.
Yeah, and Uber.
Uber, even with the robo-taxi concerns, I still like Uber. I think we're going to look back on this 2 or 3 years and say that Uber actually won from the emergence of robo-taxis. And I know this is going to take a long time before we see robo-taxis roaming around Manhattan, but we're seeing them in San Francisco, so just wait.
We were talking about that when Lyft was on. Is it that, let's just, like Pepsi versus Coke, Pepsi's got all this other stuff, Coke's just beverages. Does Lyft need some of the other things? Because there was a question as to whether Uber was trying to do too many things, but it seems to be paying off, right? Is that Lyft's problem?
I don't know what that's a decent analogy, but I'd probably stretch it even more.
Saturday Night Live, Coke, Pepsi, Coke.
Yeah, no, I'm with you. Pepsi, and then it's the company that owns Coke and a lot of other brands, too. Like, what you have with Uber is both mobility and delivery. What you have with Uber is a global play, whereas Lyft's just mobility, just in the U.S. That means its TAM, its total addressable market, is smaller. You don't normally make money investing in the number two player. Now, there may be a lot of trading opportunities around Lyft, but I don't think it's a long-term investment vehicle. I'm on the sidelines on the stock. I really like Uber here. I think it's also very cheap versus its cash flow.
So does your thesis about the payoff for AI starting to trickle in, do you now feel okay about valuations in technology writ large?
I don't know about writ large, but the names that I look at, I look at a Google and a Meta trading at 18, 19, 20 times earnings, kind of in line with the market, maybe a slight premium to it. For names, I think that can sustain 20% earnings growth, I think their valuations are very reasonable. These valuations, I think, are a lot more attractive than they were in the past. These companies have grown up under your eyes. They're paying dividends. They're buying back a lot of stock. They're doing the right things with their cash. So they should be doing buybacks, and they are.
Well, we'll see for how long. I heard them not allowed to do those anymore either. but nothing surprises me at this point. There's no AI fluff in the NASDAQ right now.
Oh, I'm sure there is. I'm sure there is. And so, what it seems like, it's the largest companies that can really afford to spend a lot on AI. It's a very expensive investment proposition. Those are the ones that are going to see the returns.
They can afford to blow a lot of money if it doesn't work.
And you need to blow a lot of money in order to get those kind of returns. I think that
like the metaverse, right?
That's what I was thinking, metaverse, and then everybody was like, no more spending on this.
Well, we have yet to see the reduction in metaverse spending. I think a lot of investors, including me, would like to see that. They're losing $17 billion a year on metaverse. Bring that down. It should be like $5 billion. It's fine to invest in these long-term projects. You're paid to do that, make these long-term bets. It's just sizing the bet to the opportunity. AI, though, the improvements that we're seeing. Listen to what Walmart said last week about how much productivity was improved by AI. That's a pretty big telling data point.
Do we have enough energy to power all of this? Because this is part of what we're looking at.
I don't know about that. That's an open question, and there's probably some great derivatives in the energy space because of that.
The whole idea, I still don't, the whole metaverse, it's like, I'd rather go to Tuscany than look at pictures, right?
Yeah.
Is that ever?
No, I think.
Who's going to live in the metaverse?
It seems like a very small number of people.
All right. Well, there'll be plenty of room at least. All right. It won't be crowded.